Welcome back to our intermediate financial accounting class. Over the last couple of segments, we've been talking about pensions, why they're important, what goes into them, what FASB requires, the different categories, how we can split them up. And then finally, we started getting into some calculations, and it was really fun to get into them last time. Hopefully, you're feeling comfortable with the logic behind each of the adjustments we've already made, because we've already wrapped up steps 1 and step 2 for our example. Assuming you are comfortable, it's time to keep going with our step 3. And step 3 actually shows up down here. It's these non-expense items. Step 2, again, dealt with our pension expense, but it's also the stuff that happens every single time. That's why we refer to them as being normal. This step 3 piece happens almost every time, but depends on choices made by the company, by the actuary, by the employees. So sometimes they happen, sometimes they don't, and we break them up. The other difference here, remember, is that the normal adjustments deal with pension expense. These adjustments deal with other parts of the pension, the other comprehensive income, balance sheet accounts, etc., but not pension expense. So let's walk through these. We're just going to keep going through this pension worksheet line by line. And the first thing we're going to do is we're going to account for the contributions made to the pension. And we were told that this company contributed $5,000 to the pension during the year. If I contributed to the pension, I sent them a check, I have less cash. That's a credit to cash, and we show credits with a negative. So I've got a credit to cash. My debit is over here in plan assets because the plan assets will have gone up because I made a contribution. The next thing that we have on our worksheet are the retirement benefits paid. This is what we have given to retirees. Now, if I give them assets, then my plan assets go down. So I'm going to drop my plan assets with a credit. They're an asset account, so credit drops them. If I credit plan assets, I need a debit somewhere, and the debit is right next door, because if I paid them, I no longer have to pay them in the future. I have satisfied some of my obligation to these retirees. So there's my debit and my credit. The next thing we need to look at is our actual return. What did we really make with these assets? And there are 3 ways to calculate the actual returns the assets made over the course of the year. The best way, or easiest way, is we get a letter from our investment company that's managing our portfolio, and they say, you had returns of $20,000 this year, and we write in the 20,000 and we're done. The second easiest way is for them to give us a percentage. You earned 30%. Well, okay, maybe that's a little high. You earned 6% on your plan assets, and we can take the 130 times the 6%, and we can put in a number that way. If I know a beginning and an ending balance and other things that have gone on during the period, I can use a T account, yes, and back into what this number is for my plan assets. And that's what we're going to do here, because all we were told was that we ended with a balance of 120,000. That's what was told to us in our numbers right here. So I'm going to move to a different screen so I can do this calculation, and I'm going to make a T account for my plan assets. I started with $130,000 debit. I was told that I ended with $120,000 debit. So we seem to have dropped. You remember we contributed $5,000, we just did that, and we paid out $17,000. And now I can solve for my return. It can be positive or negative. You can figure that out on your calculator and have a value to put into the worksheet. If you did the calculation, you should have found that we need a $2,000 debit. Again, we're just lopping off the zeros, but it's a $2,000 debit. That was our actual return for the period. So now that I know that number, it did actually grow, which is great. Sometimes they shrink. We end up with a credit for our actual return, but we did actually grow. Let's put that in here. We have an actual return of 2,000, and that's going to bring us to the 120 down here as my ending balance. That's what this row is, our ending balances. Now we've got that $2,000, and the natural thing to do with that would be to say, oh, well, that's going to reduce pension expense. Let me just put that over there because I actually earned this money, but we don't do that. Instead, we're going to put it here in our actuarial gains and losses. Now, if you're like me and you look at these numbers, something just jumped out at you and went, wait, this makes absolutely no sense. Why up here did I use an expected return? When down here I have an actual return. If I know the actual return, why not just use that? I could debit the plan assets and credit pension expense and be done. Well, companies got in a big fight with FASB over this very issue. FASB's original logic was what we just said. Look, we have two accounts. You have the plan assets and we have pension expense. What you need to do is you need to show we're going to debit plan assets for an actual return and we'll credit pension expense so that, like we said before, the plan assets go up, I don't have to pay that money, so it costs me less, it drops my expense. There's my debit, there's my credit, we balance, we're done. But companies got upset. They said, wait a minute, I have to use estimates on everything else in pensions, everything else. The present value of the obligations an estimate, the service costs are an estimate, the unwinding of the interest is an estimate because I'm not 100% sure when I'm going to have to pay things out or how all these interest rates work or statistics and everything else. Why do I have to use estimates for my liabilities but actual amounts for my plan assets? Because, you know, all it takes is one bad month right there at the end of the year and it jogs my plan assets and they drop just because of one bad day on December 31, and I'm going to have to show an increase in my expense because plan assets dropped. That's not fair. Choose estimates for one and actual for the other. Well, their argument gained ground with FASB. FASB said, okay, that makes sense. How are we going to do this? And they went back to the drawing board and they came up with a way to keep track of the actual amounts, but also to keep track of an estimate that allowed companies to smooth out and show investors over 10 years or 5 years or 3 years, here's what we normally would make that's going to help us get up to what we think we're going to owe as we save these plan assets. So they created a third account. We call it accumulated other comprehensive income, actuarial gains and losses. We call it that because it's the actuary that comes up with most of these percentages and estimates for us. What we said was, great, take that $100 and we'll take it out of pension expense and we'll show it as a gain here in other comprehensive income. Still a credit balance, it's a gain, we're fine. And we have a debit and a credit. Then they said, well, now let's look at your estimated return. And let's say the estimated return for the period came out to $80. So we take out $80 of this gain and we put it into pension expense, reducing our pension expense because of our estimate, our best guess. And company's argument was this $80 is based on a 5-year average or looking at our mix of assets that we actually own and gives us a percentage that over time this is what it's going to look like, etc. We do all these calculations and figure this out. This best guess is a much more accurate depiction and we can smooth it out over the life of the asset. Again, that's what we're looking at. So what we end up with each period, this gain or loss, we'd end up with $20 of a gain that we really made, but we haven't put into expense yet. And that's why we've got an actuarial gain or loss account and why we have two separate numbers. The big fear, of course, is that companies will take advantage of this opportunity. So we'll show 100 in plan assets, our actuarial gain and loss, we'll get that 100. And then as we get ready for pension expense, we look at our numbers and we say, you know, I'm having a bad year. My estimated return is 150. That's our concern. For a lot of companies and a lot of businesses is that they'll take advantage of this ability to estimate and they'll overstate the case. And we'll talk a little bit later on one way that FASB controls this number. Auditors, of course, are looking into that number to verify it. News sources will sometimes look at this and talk about it. All these different ways to try to keep companies from doing this very thing. Now, hopefully all of that makes sense. Remember, we're putting into this actuarial gain and loss the actual gain. We're keeping track of real numbers there, and we're pulling it out slowly bit by bit to show an average, smooth estimate over time that's not joggled by shocks to the market. And that's where these two numbers come in, the 2,000 down here and the 13,000 up there. And you can track it, the plan, the actual gain and loss, and then the expense over here. The last line item here in this non-expense category is this actuarial adjustment. We talked about that before, but just as a reminder, this is where the actuary changes his or her statistics and they send you a new number. Our life and death tables have changed, our smokers costs tables have changed, our estimate of how long your employees will live has changed based on this, that, and the other. And they send us new numbers. And it can raise our obligation, it can drop our obligation, all depends on the numbers that the actuary sends us. We don't have any of those in this particular example because it's a first look simplified example, but that's where it would go. It would be in this last line right down here. For this simple example then, that's all we have to worry about. So let's go ahead and see how this all comes together to get us our journal entries and our ending balances. And what we're going to do is we're going to add up. So I'm going to add from here to here are going to give me my journal entry amounts. So 15 plus 14.4 minus 13 gives me 16.4 down here. Prior service costs, nothing there. Actual gain or loss, we've got a positive 13, a negative 2, so I've got a 11. 5 and nothing else, so I've got a credit of 5. And we're not going to worry about this number for now, so I'm just going to put an X in it. Now that we've got our expense items, now we can get ending balances. So now I'm going to take these numbers up here and add the journal entries. So 0 plus 0 leaves me with 0. 0 plus 11 gives me a debit of 11. Cash, I don't worry about because there is no ending balance to cash for pensions. There's too much involved in cash for us to get a balance because of a pension. So we can't get cash. We also don't have an ending balance for our pension expense because it's going to close to retained earnings. So there's no ending balance there either. What we can do though is our projected benefit obligation. So 120 credit minus the 15 minus 14.4 plus 17 gives us an ending balance of 132.4. And my last step is going to be to get the net pension obligation number. Again, that's the difference between the assets and the liabilities. So in this case, my liabilities are higher. I end up with a net pension obligation of $12.4 thousand. Now that I've got these numbers, I get to do my journal entry. Man, I've been waiting for this, let me tell you. Hold it, time out. I know we're all really excited to get to our journal entry, but we have to pause here for just a minute to talk about a change that FASB just made to pension accounting. Now, sometimes when FASB makes changes, they make huge changes, sweeping changes that really affect our financial statements and our calculations and our journal entries. And sometimes they make minor changes that don't require a huge amount of work, but requires to just tweak a couple of things. And the good news is the change in pensions is just a minor tweak. Basically, what they've decided is that they don't want to lump all of this column together as pension expense. Instead, they want to break it down into the part that our employees are actually earning and the part that is market driven or estimate driven. So what we're going to do is we're going to take this number, that's service cost, and we're going to include it as part of our compensation expense, whatever our company calls that, whether it's wages expense or salaries expense or payroll expense, whatever we call our compensation, that's where we're going to put this number. The rest of this column we're going to add up and we're going to call it net pension either cost or benefit. Now, most of the time, these numbers are still going to add up and give us a debit balance, which means it's a cost or an expense or a loss. And so we'll call it a net pension cost, and it will show up as a loss down in our gains and losses section of our income statement. Sometimes, though, because of either our expected return being really high, or because we've got some amortization that we'll talk about later going on that gives us a credit balance, we'll end up showing a credit or a negative value in this column, taking out the service cost. And that will give us a benefit, a net pension benefit, a gain or not really a revenue with money coming in, but just a reduction in our total costs for the period. And so again, it will still go in our other gains and losses section, but it can show up as a benefit. So let's still go ahead and do our journal entry, but instead of doing the old way that we were going to show you, let's do it in the new correct way so that we're comfortable with this method. So we're going to take that first $15,000 and we're going to call it compensation expense, or again, wages expense, salaries expense, whatever our company uses to show the compensation for the period. And that was $15,000. It's just that number from service costs right here. And remember, we lopped the thousands off of these just to make it easier to fit into this table. The rest of this number, so the 14.4 debit and the 13,000 credit, we're going to add together to get 1.4 thousand, and that's going to be either a pension cost or a pension benefit. Now in this case, we've got a debit, that's a cost, so we're going to record a net pension cost of $1,400. And the sum of those two numbers will always be equal to this journal entry total down here at the bottom. Now that we've accounted for the pension cost, that's 16.4 thousand, now we're going to keep going along the line. So we have a debit to actuarial gain and loss for 11,000 and a credit to cash of 5,000. So let's go ahead and put that in here. We've got accumulated OCI, actuarial gain and loss for 11,000. And then we said we had a credit to cash of 5,000. Now we need to put in a plug to make it balance, and the plug that we use is our net pension obligation. So if I take the 15,000 plus the 1,400 plus the 11,000 minus the 5,000, I need 22,400 to make that balance. And this is my adjusting entry for pensions. Now normally I would go through here and I would actually put in details of my calculation and what I did to get that adjusting entry and all of the values in it, but that's a lot of work. So instead what I would usually do is I would put a note, please see figure 10, which basically would take them back to our pension table. Now I'm not done yet. I can't stop there. You see, I want to make sure that I did this right, and to do that I'm going to actually look at my T account for my net pension obligation. And if you remember, we started with a debit balance of 10,000. So I'm going to put that in here. And we've just credited the account 22,400. So using my beginning balance and my journal entry, I now think that this account should have a balance credit 12,400. And I'm going to check that with this number down here. If they balance, I'm good to go. If they don't balance, I've done something wrong. So that's my check to make sure that I've done my journal entry correctly. In this case, we wanted 12,400 credit. We got 12,400 credit, so we're good to go. Now this segment has gone long, so we can keep this whole example together. We need to take a bit of a break. When we come back, we'll be starting to talk about the more exciting parts of pensions. Now we've got these basics down, the real fun can start. We'll see you then. Thanks.